This is Max Gagliardi, and we're here live for this week's episode of Talk.Energy Insights on September 17th, 2021. We've got a guest today, Max Germin, and I'm going to kick it over to Heikkinen. He's going to touch on today where the markets are at. And Hike, you got two Maxes on with you today.
I know this is my brother Max and my other brother Max. So y'all introduced me to each other, so I appreciate it. Good to see you, Max. And
Max G's.
Both Max G's.
Yeah.
Gets confusing on conference calls, I'll tell you.
Yeah.
No, it's been, I bet. Hey, just call yourself by your last names. Hike works pretty well for me. So markets, like energy markets are doing phenomenally well. I was a little bit early on my oils going to 90 whenever we first started doing these in June, but it sure seems like we're back in rally mode for oil, and natural gas is killing it. So like the reality is you've got energy outperforming, a broad market kind of slight pullback, kind of consolidation of this crack up boom that the broad market seems to want to keep going in. And crypto bouncing around. The KRBN on the carbon side is kind of down a little bit, but it's been up nicely over the last month, and year to date it's killing it. So we'll talk more about carbon markets. That's one of the things that I know you mentioned on Chevron's update. They're very clearly responding to investor interest with, I think it was 5 or 6 different press releases before their investor day this week. But really wanted to talk through like Max G or Germin. What is what's happening with oil and gas rallying in the private market side? Like, is that changing deal dynamics, or are people less likely to sell, more likely to sell? What's happening?
It's been deals as opposed to public markets. They take time, right? I mean, from the reaching out to the bankers, getting everything prepped, data room, launching the process to getting bids. I mean, you're looking at 3 months. So I think that they obviously have over a longer timeline than prices have reacted. So I don't know if we've really seen it impact any deals that have been announced, right? Because those deals would have already been past PSA with effective dates set. I think seeing the gas rally, a majority of the deals that we had historically looked at were gas heavy. Those were the PDP deals that were going, and those were the only deals that you could reasonably think you could get at a good value. But also crude just wasn't getting sold. Now there's been more West Texas crude heavy deals that have gone to the market, and more mixed product deals that have been announced as well. But I would say that when commodity prices ran up, we had a little moment where we thought, okay, guys aren't going to have to sell. You deal with distressed gas names, especially ones that, that may be public, that have debt burdens. You're like, they survived, right? And so they're not really incentivized to sell. What we've heard more is that people want to monetize now. And, people throw out numbers. There's going to be $10 billion worth of assets on the market in 12 to 18 months and something like that. There's only a fraction of that of capital available. And, these numbers they're not conjecture, but they're not based on anything you can quote, but that feels roughly right. And so I think that it'll be interesting because I do think people want to sell. They do want to monetize. It's a weird looking strip, right? Going from north of 525, then getting backwardated. But the tail at 350 for these assets makes a huge difference in valuation. I mean, especially long-lived child decline gas assets, and then crude has great crude has kind of a great story emerging as well on the supply side. And so I don't think it's going to curtail deals getting offered. I think that capital is even more going to be strained to actually close the deals with the valuations growing. And I do think the first thing that we've seen most tangible is there used to be a lot of effective close date gamesmanship, right? Where you essentially borrow on the seller's balance sheet, essentially, call it 3-6 months worth of time value money. I think now you're seeing it, especially with how these assets look. I mean, sometimes, you're multiple on 22 years out deal value, even with the decline, with a shallow decline could be like 4 or 5x, but now over the next 12 months, it's 2.5, 3x. And so people are pushing out those effective dates. We're looking at an opportunity where they just flat out, they pushed the effective date out into 2022. They saw the storage crunch headed into the winter, and they were like, we're not dealing with a situation where, you take 3 months to close the deal, or, you peg an effective date, to a certain point, and now you're basically capturing all these cash flows. So that's the very first thing. But I think markets are active, and you kind of see these small changes. But I do think it'll be interesting from a valuation perspective, because these values are, if there was going to be X billion dollars worth of assets for sale, that's just jumped up in value by 30%. And it's not, we are a capital starved industry, so I don't know. I don't know if it's that easy just to flex upwards. So I think a lot of guys are going to be sitting on assets being like, I want to sell. And bankers are going to be like, it's the same group of 15 buyers, and 5 of those have already bought something that they got to process, or they've already spent their money. So that's our perspective.
Yeah. Well, I was going to say is it seems like at least the motivation is ramping up on the sell side. Whether that be upstream or midstream or whatever part of the oil field services, whatever you're looking at in the oil patch, this last 18 months, well, really the last, call it 2020, the beginning of 2021, there was just very little motivation at all. I mean, nobody wants to sell in a down market. Nobody wants to leave potentially value on the table. No one wants to have their arm twisted to exit an asset, even if it makes sense for them to do so, even if the writing's on the wall that this is the best time for you to do it. Psychologically, there's a huge barrier there, and they were given enough leeway on the debt side or on the banking relationship side that they were able to kick the can in a lot of instances with a lot of these companies. And so now, at least with the prices being where they're at, and this surge of, especially on the gas side and the NGLs, the surge of pricing is at least lit the fire under the sellers to be like, let's strike while the iron's hot, let's do something. But that doesn't mean it'll transact for all the things you mentioned. Are there buyers there? Is the capital, on the other side ready to take on these type of valuations? But at least it seems like that's a tailwind, is that these sellers are motivated. Is that what you're seeing, Max?
Yeah, 100%. I mean, it's, we haven't seen $5 gas for any sustained period of time. I don't know how, you got to go back a decade, right? I mean, you had probably like a brief month or two at some point. And so I think people are excited. I do think that, I think that private names are ones that have gone through processes, ones that are already in portfolios that need to be monetized. A lot of private equity groups they're out of the game now. They're going energy transition. Some have succeeded in transitioning, some haven't. And so I think that they're like, now is the time to sell. But it's the same story where if you look, I mean, we're an anomaly. I mean, our high yield debt market is 600, 700 bips above anybody else. It's not going to be the same spread on investment grade, but everything that in our space is more expensive. Money's more expensive. You have massive, I mean, we can get into kind of some of the headwinds oil and gas faces, but it is a big deal when you've got, between BlackRock and everybody else, $20+ trillion worth of AUM or something like that could eventually say we're not interested in oil and gas investment. So you're kind of in a weird place where, whether you like it or not, I think we're going to be forced to free cash flow yield, and you're going to have to go back to LPs and investors. It's like, here's your check. This is the way the industry's always been run. You're going to have to accept money. It's not buy and flip anymore. And I think a lot of people are going to be like, it's hard to stomach when gas is $5 and crude rally to, like Hike said, 90, 100, or Goldman's saying, and everything else. It's going to be a weird time, for sure.
What's the best way, in your opinion, to play it right now? Is it to, because I'm hearing guys in the PDP buying arena and they're struggling. It's getting hyper competitive. You've seen, I personally know of groups that have had $1 billion+ commitments. Hey, go out and spend this $1 billion. They're sitting here 12, 18 months later, can't get it done. They're getting blown out of the water on valuations by other groups. You see groups transact, and, I heard of a deal, we won't call names, but a deal just this last week, and someone said that the winning bidder was 2x the second highest bidder, 2x. And lo and behold, that group actually has a management fee on what they deploy. So, there's incentives here to spend money. You can make a lot of money on management fees. You can make a lot of money if you own assets, even if those assets you pay too much to get into them. And so you see there's motivation to deploy this capital into the PDP space. And there's appetite for it, but that's also causing maybe distortions. So is that the best way to play it, or is it possible to buy PDP at a good value right now?
Yeah, it's definitely possible. I mean, we've looked at, I'll say this, that if there's, all these numbers, they're kind of hard to compare, right? Because people throw out a set discount rate and makes life easy, right? You go PDP is for PVX, 15, 13, whatever, 17, or, depending on the asset, the profile. But once you add in inventory, I'll say this, people flat out will pay for inventory.
Right.
They will pay for development upside. They always have in the industry. They will never break that they were willing to pay for it. And it is surprising, PDP, you say, well, two engineers are going to land within 5-10% of each other. And that's kind of roughly true. But obviously when you throw in inventory and we don't have really a mandate to buy inventory. So if we're in a process, we already know which ones we're going to be competitive on and not. And so that wasn't the case 12 months ago, whether it's because of pricing or just the capital availability and the motivation of the sellers. We knew we'd be competitive in any process. That's not the case now. And so if we know that there's actual upside value, development value, we're out, because it's no longer PDP plus. People are paying. And I will say this, that, there's oil, oil and gas it's a bit of a bitter industry, right? And I think we all love EFT, but there's definitely a little bit of people are overpaying this and that. Nothing can compare to the way things were. Nothing. I mean, reality is, okay, you're paying up, but you still have a massive production base. Right. Your investors, if you're disciplined and you're structuring, you don't over lever it with poorly termed debt, and you don't just go naked in front of the commodity price headwinds, or not headwinds, just the commodity prices. You're not gonna lose your shirt. And just to think, so I think there's a little bit of we got to remember 5-7 years ago, 10 years ago, when people, and some people made money, but you would invest in development that just had a binary switch. It just goes to zero. That was 75% of your deal value. Right. And so I think that capital, I think that these guys, they're overpaying. But my instinct is, with capital discipline in our industry, the supply side issues that we're seeing on crude, DUC inventory being where it is, and associated gas coming off, I do think we are always going to fight regulatory issues on incremental spending, even for a myriad of reasons. I think that they're going to look brilliant, because I think commodity prices are going to. I think that curve isn't going to be maybe $5 flat through 2030 plus, but my instinct is it's going to be higher, and I think everyone's instinct is going to be higher. Maybe on the near term it'll drop, and I don't know what the floor, the sustainability is of 525. It's a unique storage time, but I'm guessing it'll go up on crude and gas, and I think these guys will look really smart. Just basically based off of that alone. So even if they're quote unquote overpaying right now.
How many sources of capital do you think are out there that would sponsor a management team today in the oil and gas acquisition side?
Sponsor
less than one hand?
I think
a new team
to actually get a search fund, the historic, hey, here's 3 years of G&A. I don't know. I don't know any team. I think that you'd have to be real special.
You have to own it. Almost. You'd almost have to own part of it already. It seems like none of these guys, they just want to fund their existing teams, right? I don't know.
Yeah, no way. You've seen mass consolidation of teams already. No way. And you see a lot of contract operator names popping up that we expected, guys that are in the business of basically taking over and running leaner on assets that are going to be eventually sold. So no, it's a business that if you want to stay in the kind of traditional, I'm a management team, I've described this to people outside of the industry. I said, imagine that you need they're like, well, what do you do for a living? I was like, well, imagine that you need to buy a factory just to work at it. I was like, that's kind of what I do, and they're like, that sounds ridiculous. I'm like, Yeah, I mean, like, but you live long enough in it, you lose all perspective. You're like, maybe it is. Like, what do? They're just like, well, we just get a paycheck and time off, and it's real nice. And you're like, damn, that's kind of different. But
Yeah.
But I think that you're going to have to stomach that you're investing in your own business. Like, that's just the way it is. And I think that that's going to create opportunities, because it's like there's less capital, but there's less teams. There's less people in industry, and top line revenue. It's a steady production base. Maybe it doesn't have crazy development, but I think a lot of these assets are maturing, and top line revenue and margins are going to go up. So I think it'll be a good time for people that survived and that stick with it. And I do think we're going to get labor and capital inflow for all the auxiliary projects, like that are, every oil and gas conference now has an ESG, panelist, right? And I do think more and more, you even see the press releases, people frame everything from that perspective. And I do think you're going to find more and more individuals that are brought on management teams, service companies that are associated that create auxiliary value via some type of environmental monetization, whether it's carbon capture, whether it's, people talk about lithium mining, like more far-fetched stuff, but
Right.
more and more we hear about creating auxiliary value around these projects. And I think that might make capital easier to raise as well, if you can get into pockets that are less inclined to just straight up buy hydrocarbon production and hydrocarbon development.
Yeah. What about the drill bit? Are you going to see anybody? I mean, private guys, it's like, it seems like, for example, in a state like Oklahoma, where you can, aggregate interest in your force pooling rules, can you get in there and get after it with a rig and grow up, a PDP position in a acres position through the drill bit, and maybe you can get some guys to go, give up their interest and grow an asset that way, and it's a lot cheaper point of entry. Is that a strategy? I mean, I'm not an E&P guy necessarily, but I've worked for them my entire career. Is that something that guys are looking at, or is it still too risky to drill anything?
No, there's definitely, we know groups that have raised sizable amount of money around drill co style investment. It's less what you've seen before, which is wholesale farm-ins. It's more like wellbore only. People still want to see those development economics, and the money's there. So yeah, I'd say the deals are still very PDP heavy. And the money is easier to still raise around getting exposure to development style economics, which just match the return profiles and time horizons people are interested in. I think I don't know what the monetization pitch is anymore for anyone really, because I don't know. That's the problem. I think that's always that's going to happen is, we've got however the dollars that were deployed during the PE era, whatever that number is, that was always predicated on an exit. The assets that you're buying now, there is no foreseeable exit. I mean, you're buying a production, even with a development component, you're buying a very large production base, and the likelihood that you flip it back to an operator, there's no public yield vehicle. And there's no, we obviously have our strategy, but having a conduit towards people that invest in yielding style products as generalists is not well established for everyone. So I don't know how the pitch is going down for the drill co style investors, or even for the investors that have recently made these larger acquisitions. I don't know what they're telling them in terms of how do you eventually flip this, if they are traditionally minded, like, I got to get my money back in 5 to 7 years.
Yeah. I'm wondering, from a bootstrap. Go ahead, David. You asked one.
I was just curious, what would you say a free cash yield on a private portfolio would be today? If you're looking at one of the smaller private equity groups, I'm just trying to compare it to the public equities, what the spread is. If you have any thoughts, you may not have an idea.
Yeah, no, I've got. I guess on the publics, I mean, I think there's some extreme gassy names that are claiming 40% yields. I think others are kind of broad, 15, 20% yields. I would say that on opportunities that we look at, obviously incorporating decline. I mean, I would say that the yield profile vary anywhere from 15 to 30%, depending on the decline of the asset and the margins, and obviously midstream and everything that a lot of times burdens those margins in gassy style deals. But healthy with paybacks, with unlevered paybacks that are, I think reasonably within a 5 to 7 year time frame. Massive ROIs if you stick with it. I would say that's kind of
interesting.
Looking at our deals, and that 40% number that I quoted, I kind of read somewhere that on gas, and I'm not surprised. I mean, based off of entry points, I think that's feasible. I think that your yield drops as you get to scale. That's just the nature of the competitiveness for larger deals. But I would say on the smaller side, I've seen deals transact at 2-3x multiples, so it's going to be a hefty upfront yield, if you manage to buy an asset at that amount.
That's an interesting push-pull of companies that are setting up their return, the public side of setting up their return metrics on a free cash flow yield, after CapEx, and like, does that say that they can go buy assets and juice their free cash flow essentially on some of those smaller deals? Like, do we see the publics, nipping and tucking in, a little incremental cash flow here, a little incremental cash flow there? So just watching the acquisition line item probably makes a little more sense. If you got that.
It's interesting because you see kind of the big boys, right? The ones that are, your Chevrons and Exxons of the world are finally divesting, steady state production, because they know that that's what they need to fund the development program, and cadence is very important to them. But it's still a little bit like, with everything I kind of thought that wouldn't be the case, but they're going through the divestitures, I think, because they do need that cadence around and that growth profile. And I don't think that they're going to have that CapEx budget to basically be able to run that, not those guys, but, for most public E&Ps have that, they need to generate a proper yield. And it's hard to do with the way that shale comes online and everything else, to have any level of cadence, you can have a variable rate distribution, but have any steady state distribution. So I think maybe they just want that cash on hand, and I can't presume to know exactly what they're planning, but
Yeah, some of the quarterly payouts for any gassy assets are going to just slap people in the forehead from a retail investor standpoint of like getting in before these variable announcements. I think are going to be pretty impressive given this quick rally in the price, even with the hedges that are out there. So you could tuck in some unhedged production on a $5, $10, $15, $30 million acquisition, boost your cash flow even a little bit more, given what you were just talking about. And so we'll definitely watch that through third quarter and fourth quarter reporting. Like, do you see a little more of the A side as opposed to the drilling side? So
yeah, I would say that there's definitely massive arb. I said, on the yield front, on the private side, it's existed for years now, where and if those guys have access to their cost of equity, they're all in cost of capital. It makes all sense in the world, but like I'm saying, you're seeing divestitures, which kind of are counter-logical to that. We haven't seen, none of the transactions that we've seen in processes that we've participated in, has there been a public operator that's won, or that we've kind of really heard are in contention. We're looking at one deal now where I think that might be the case, because of operational overlays and where the asset is, but not on the others. They, I'm guessing if they're in acquisition mode for that, they'd rather go stock for stock with another public name, which is going to be harder now with the rally, to get kind of, you're doing well, the others are doing poorly. That doesn't exist as much as, anymore.
All right.
This is good. We keep going on this topic. I love the technical on the stuff on the M&A side for upstream, but the broader theme of just kind of the capital markets, not just what we have access to as a private guy, what the public guys, the pressure that they're under, and just the general ESG kind of green movement themes. You're hearing the new rumors of the new legislation that wants to get pushed through on this Build Back Better type program, where they want to keep incentivizing the green and the renewable stuff. But all of that kind of in the backdrop of, what's going on in Europe with energy prices. We're in the shoulder month today. I mean, the thing that's amazing about gas is that this is typically the time of the year when we see weakness, and we're seeing this kind of strength. Right. And we're seeing people, and maybe this is a bit doomsdayer, but people throwing out things like looming energy crisis around pricing. And you're already seeing it from even from the president saying, why aren't gasoline prices going down? I'm going to investigate this. It's like, well, it's called, BlackRock and everybody else putting all this pressure on, institutional investors to not invest in oil and gas projects. Right, exactly. And so is this energy crisis narrative? I mean, how does this play out? I mean, is it going to be enough $100 oil if we get there, $5 gas if it stays there, $4 or $5, whatever that number is? Is that going to be enough to attract investment and attract the drill bit and kind of levelize these prices? Or could we enter into a future period of much higher commodity prices with the backdrop of just this, fundamental lack of investment?
Well, I'll say this. I'm not going to say that I've done a deep dive on any of these, the recently launched EFTs, all the kind of more socially conscious investment vehicles that have come out. And I know that there's always like, well, how did oil and gas names get smattered into here? And it's because they do want some of that blended return. They do recognize value in the industry. And we also know that a lot of names, institutional names that have very public positions, privately participate, not privately, but they'll participate through various avenues in oil and gas. Sure. And just kind of they deal with the disclosures however they want. What I would say is this, that I do think that there is an element in the oil and gas world where there's a naivete about what's going on. And I do think we're in for sustained higher prices. And I do think that with all the general inflation that's going on, right, that we will get scapegoated flat out. And I don't think the resolution of this is, hey, we were wrong. When I say we, obviously the administration in place has a very specific view on oil and gas. I don't think it's going to be like, well, you know what? Yeah, we made a mistake. Let's boost the U.S. oil and gas industry. I mean, think about it, like what we've done, and a part of it was on the European side too with LNGs, but Nord Stream 2 is happening. That's it, right? Ostensibly, we're supposed to geopolitically be trying to isolate Russia or try to counteract its influence, but it's happening. And that is, I don't want to, I'm not going to comment on the politics of it, but, it's kind of funny how it plays out, but that shows you the level of essentially antagonism that there is towards this industry. So I think that, if you go to the pump and gas is going to be $5+ and everything else, and then suddenly I do think there's going to be some level where there's going to be worries about like some anger in kind of voter blocks, but I don't think that we're going to get, I think we're facing massive regulatory headwinds. And I think that we'll be surprised. Yeah. People will tear their hair out and they'll say this isn't logical, but they're missing the point, is that the elimination of hydrocarbons and the massive money that's going to be available and will be available to make through the actors that institute the renewable policies and everything else, is that force will overcome any concern about $5 gas and what it means for the economy and what it means for the average person. So I don't know what it's going to look like, but I think we're going to have some nasty surprises once we start hearing about the plan to mollify inflation, which a lot of it, even on the agriculture side, comes from us, right? I mean, ammonia, et cetera, else, everything that you need to use in agribusiness. I mean, we are the genesis of so many things in the supply chain. And I hate to say it, I just don't think it's going to matter. Like, I don't think we're going to get a reprieve from the negative publicity and the negative attitude we have from the government.
No, I think it's more likely that scope 1 and scope 2 emissions become a carbon tax. I think there's methane tax possibilities. I actually think that the the higher the price is, the rapid and faster the transition could be.
100%.
And that
right.
is that's a mindset shift. And I actually think that I'll be interested to see, but we wrote about it and we're thinking it through, like, what is the price of carbon that we should be putting on, scope 1 and 2 in our asset valuations? Because, do believe that the Chevrons and the Exxons of the world are burdening project economics now with some carbon pricing. And so realized that I actually have a 1:00 call that popped on my calendar. So I'm gonna have to hop off in a little bit to just wrap up. But I think that, Max, the question is going to be, if you put, I don't know how much methane venting or flaring is on your PDP assets, but I'd be wary of that as you start thinking about $40 an M methane taxes that could get hit. And so that's just something to pay attention to. And we did some quick math on it, just on the amount of flared gas from the BP Statistical World Review. It's like a $25 to $30 billion tax on the industry that could start in 2023. I mean, like that, just on methane venting and flaring, not the CO2 equivalents. And that's pretty darn significant. And it's basin by basin and something to be aware of. So just pay attention. We can talk more about it offline, but it's just something that you might want to factor into your economics as you're looking at deals.
Yeah, no, I definitely appreciate that. We should definitely chat about it offline. I think that we've actually been trying to avoid assets like that. We haven't looked at a lot of crude heavy assets, but when they were popping up, I mean, there's definitely ones where that's not a part of your typical initial DD review, and you typically don't have a lot of outs post PSA on what you kind of find once you do that deeper dive around it. And so, but I fully agree with you. It's something to be aware of. Like, I don't see, I mean, I think that they're going to be, those type of things are going to keep scaring some capital away from our industry, because it's just, it's another variable. They don't want to invest in, it's the number one thing. When you invest in something, you want to know what is the steady state. And if you don't have that in an industry, it scares investors.
Yeah, the craziest thing is, like, the cement industry is, I think, 8% of CO2 equivalents. Steel is about the same. I think it's like 3,000 cement plants and 2,000 steel mills, and there's only one steel mill in Sweden that's producing, green steel for Volvo. And the reality is they're all getting carbon waivers, and that's really the other side of the equation of, like, fundamentally in their process they're emitting multiples of the flared amounts, but we're not talking about that side of inflation. So I don't know. It's gonna be, we're thinking a lot about price of carbon, is what I'd just tell everybody. It's there's a compliance market that is the stick, but I think there's actually going to be some carrots out there as well. Just be thinking that way. But I'm gonna have to hop, guys.
Yeah, if you got we'll go for just maybe a few minutes. Yeah, thanks, Hike.
Yeah,
Appreciate you coming on.
Thanks,
and you can drop off. And Max, we'll go for a few more minutes. But so I tend to agree with you on this last topic, and I think that I've kind of heard from Heikkinen, had Pickering on, and some other guys that very much say, hey, this is, you can't turn the ship, right? Like, it's steering this way, and it's going to go this way. But the part that I struggle with is, if you look at, like, worldwide, what we're trying to accomplish, and you look, I think this year China surpassed the entire Western world in emissions. I believe they're over all of the Western countries combined. They've now surpassed that. You add in India and Russia and a handful of other countries, and really, like, the initiatives that we're doing, I guess let's put it this way: the amount of impact that these initiatives can have on production is huge. I mean, like, in terms of the worldwide scale, because China's not a big player. Some of these other groups, India's not a big player. So starving capital from the production side can be massive in terms of what that can do to price. We're seeing that right now. But in terms of what it can do to reducing CO2, I think it's very little, if any, what it can actually do. I think we'll look up in 10, 20, 30 years, and these other countries will have not have complied, probably. I mean, this is just me game theorying it out, yet we will have, basically torn down an industry to not achieve any of the CO2 reductions that we're trying to achieve. And so I just am struggling to believe that, like, the ship can ever be turned, because I don't think we're going to get there the way that they're going about it. But maybe that doesn't matter. Maybe like it doesn't matter whether CO2 drops. They're just still going to kind of dismantle the oil and gas side of the equation.
I don't think that it matters. I think that people are having a really hard time internalizing that. But California is decommissioning, I might be wrong, I think it's last producing nuclear power plant by 2024. Vermont deconditioned theirs.
Right.
They now import, essentially they're a net importer of natural gas, obviously, to make up. They didn't make up for that delta with the renewables. And people say, well, that's not the mindset of the side that wants to see hydrocarbons essentially not be a part of the fabric of American industry, Now, I don't think we're going to ever, we're not going away. It's a massive industry. It'll stay a massive industry. But I think that I actually don't even know what the implications are for regular people like you, me, and Ike. I mean, working in it, I don't think there really are any. I just think that I think it's just going to be, I think even when we discussed it a while ago, I don't think anything's changed. I mean, look at the infrastructure bill and kind of how it's looking now. I mean, I think that we're just looking at a smaller steady state industry that
could it be a good thing in some way for entrepreneurs in oil and gas? Like, could it be higher margins, better profits, more actionable acreage opportunities for the guys that aren't mired in either whether it be bureaucracy at the public level and the reporting requirements and the public sentiment, or that maybe you're not on federal lands, but for the others, could this be in some ways bullish for what we do, which is entrepreneurship in oil and gas?
Yeah, I think that it's bullish for private names. I think that it's bullish for people's cash comp, probably ultimately.
Right.
I think that the VC style of investment that occurred during shale, which was drill the minimal amount of wells for the maximum flip without risking a type curve that someone will pay for, I think that that's dead and gone, which I think is going to drive out in this interest rate environment. PE groups already were struggling to generate the ROIs. I think that they're going to be, unless they really restructure the LP mandates, I think a lot of them are going to be out, which they already are. But I think it'll be, if you stay in it, especially if you're on the private side, I think there's going to be a lot of opportunities. I do think that it's important, for anybody out there is to, and we're happy with our capital partners. We have a very similar view of the world and how things play out. But I think it's going to be very important to find the right capital partner, because I do think people still want exposure to the industry. People use tobacco as an analog. I mean, I hate doing that just because tobacco is a singularly, it is what it is. And, oil and gas is it's not a vice, right? But you saw the return profiles of those stocks after kind of the massive restrictions they faced, whether it was advertising, incremental taxation, et cetera, they outperformed the S&P by a wide margin, and they generate a yield, right? With proper dividends. So I think that, I think that's maybe where we're trending in one way or another, because we're not going to go away. I mean, reality is we underpin modern society, right? So there's going to be some level of, but maybe it's optics, maybe it's virtue signaling. It'll have real bottom line impact for us, but I think we're still going to find capital, maybe a lot more of it on the private side. But like I said at the beginning, at least right now, we're capital starved, and we're still normalizing, I guess, to whatever the future looks like.
Yep, 100%. Well, I'm going to jump. I'm on vacation here. I got to go try to finish this out. We've been a long week here down in Florida, but thanks for coming on, and let's do it some more. I mean, I think it's fun and it's easy to get on these quick little discussions, and hope some people find value in them. I get good feedback on them. Got good feedback on the episode you came on and did, where it was you and I for over an hour. So hopefully we can incorporate you back in, maybe make it a regular thing every couple of months or so. I think that'd be fun.
Absolutely, man. I'd love it. Have fun and Disney World actually sounds like an absolute blast. I don't know if you want your location disclosed.
I tweeted about it. Yeah, I'm at Disney World. I'm at Animal Kingdom. I've got the like a animal Africa style hotel. It's pretty cool. Got giraffes like walking outside the window. So it's been a fun trip.
That's awesome. I would highly recommend everyone take vacations. You're going to be way more productive afterwards. I think that even with the pandemic, we all deserve one. Even if it feels like a surreal halfway vacation.
Yeah, outside. A little bit. I've been pent up. We just decided just to do it. We planned this like a year ago, so we had to make it happen. But all right, man. I'll talk to you soon.
Man. Yeah, I'll talk to you.
All right.
Bye.
See you, Max. Bye.